So, what is inflation? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon and welcome to the Prudent Money Radio Show. I'm your host, Bob Brooks. Thank you so much for joining me today. You know I do appreciate it. Well, if you got a question for me, I do have a resource for you. Just go to the website at www.prudentmoney.com. And when you get there, there is a link at the top of the page. Just click through and you're in good shape. We'll get you taken care of. Very, very committed to taking questions through that portal. And there's no gotchas. There's no we're gonna take your name and your information, and then we're gonna go do something with it. It's purely ministry based. So I know that there's a lot of people that have questions, don't understand what certain situations mean, and I am so very committed to making sure that you're not in that boat. So in fact, we're going to be talking about inflation today and what all that really does mean. So if you have a question about anything stewardship money related, and I can point you in the right direction or answer the question myself, I certainly would do it. Happy to do it. Just go to prudentmoney.com. There is a link at the top of the page. Just click through and ask your question. We'll get you taken care of. If by any chance you have sent in a question and not gotten an answer, please check your spam filter and or give us a call and let us know that you have not received your answer, and we'll get it taken care of. That's all at the website, prudentmoney.com. A lot of questions came about or came up because of what we talked about yesterday, which was what was going to be happening with 401k plans and how President Trump is allowing new types of investments to become available to people in 401k plans. And there's a lot of detail that we talked about, and I kind of want to take it up to a 5,000 foot level and help and describe it this way. In 401k plans, you have nothing but boring investments for the most part. If the market goes up, maybe you have 3 or 4 of the stock funds that are going to go up about what the market's going up, or you're not going to get anything really exciting happening in bonds. It's going to be pretty boring. There's nothing wrong with boring. If you had extreme excitement going on or extreme emotion going on, let me say it that way, in your 401k plan, it's either really making a lot of money or it's really losing a lot of money. So that's just normal stock market stuff right there. And that's what the foundation of retirement plans, corporate retirement plans, should be based upon. No question in my mind. And let's say that, President Trump comes in and he says, I want to build a framework to where 401k plans can participate in investing, and you'll hear these two terms, private equity, and then you'll hear alternative investments. Alternative investments is the category, and it simply means investments alternative to standard market type investments. What I want to make sure that you take away from this is that unless it's an extreme situation that we didn't see coming, I think though the probability is so extremely low, it's very, 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 very low probability of happening, that you put your money in a 401k plan at a corporation and lose everything. I can't. Even if we had a nuclear war, would that be the case? I have no idea, but it's a very extremely low probability. That's just based on my opinion, because just if you look at the way a mutual fund is made up, say your average mutual fund has 150 to 200 different companies represented as investments inside that mutual fund, every one of those companies would have to go out of business. So your Apple of the world, your Microsoft of the world, these companies that are these big multinational companies would have to go out of business. So you want to assign a probability to any type and every type of situation possible. That is in my opinion, a low probability outcome that you're going to get. Not so much for alternative investments. The way they are structured, and it could be anything from what's called private equity type investments, to real estate types investments, to Bitcoin, and people. It's one of those things where you've gotten a taste of what the market can do, and you want to take more risk. And I have no idea how they're going to structure this, so keep that in mind. And there's also a whole nother side to the story that we only talked a little bit about, but let's keep it focused on the investor part. I don't know if they'll make funds that contain these types of investments or whatever. The bottom line is you're looking at a lot of companies with a lot of debt, tremendous amount of debt, taking tremendous amount of risks, and they're trying to hit the home run ball. You don't really have that in your standard 401k investment lineup, but that you do have with alternative investments. And you got a lot of people wanting to make a lot of money, and it can be, if you let it get out of hand, it can be really based more upon greed than anything else. So, yeah, that concerns me, because the marketing is going to be slick. The regulatory environment that the Trump administration is putting out there to protect investors is not going to be that strict. I can already predict that. And because they're wanting to rush this thing into existence, and something that's this major change as this people need to be prudent about the process of putting it into existence. So my concern is someone's going to see this, they're going to read the marketing, they're going to go, oh, why wouldn't I put all my money into this? Or why wouldn't I put half of my money? Because it's not a good idea. According to principles of stewardship, it's not a good idea. And you've just introduced a tremendous amount of risk into your portfolio. So I'll keep talking about this and keep bringing it up as things change or as I read more about it, so that you have an idea of what you're dealing with. But that was the gist of yesterday, and it's just that if you once these come on board and are available, they will be tremendous, will make up and provide the 401k investor a tremendous risk category that they haven't been exposed to. Got to be extremely, extremely careful. Is there a place for that in an investment portfolio? Of course there is, if you have the risk level for it, but still, even then, does it make sense to put 30, 40, 50% of your money into it? I don't think so. And especially when you're going into it and investing for the home run ball, I would be really, really careful. So that's just my 2 cents worth, and take it for what it is. But alternative investments is what they're going to be looking at. I would be willing to bet we'll be seeing that available to you as an investor within 8 months to a year, probably. Now, where the The rub comes in is that the people at the company who are in charge of the 401k plan, they have a fiduciary responsibility to all their clients. To all the employees, and if they violate that, then they could get sued. And there's been tons of lawsuits over the years of lack of fiduciary involvement and oversight. So I don't know how you do that with these programs. They could at any point go belly up, and because here's something that you want to remember: if you are looking for big risk and big returns, then the company that you're investing in is going to have to be looking for big risk and big returns. On the other side, the downside, the nightmare side of all that is losing all your money because you went for the home run ball. Think of it as the home run ball. The 401k today, as it stands, is hitting singles. Your alternative investments is hitting home run balls. And I'd hate to think that they would do this, but if you could always be forced to sign off liability if you wanted to invest in alternative investments. They've got certain criteria that you have to pass, or that you have to meet, to invest into them today. And that's going to be interesting to me how all that works out. I would never sign away my liability on that. Never would. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. We are looking at Up Against the Break. Stick around, and I'll be right back. Hi, this is Bob Brooks, host of the Prudent Money Radio Show. Marriage and money can be a toxic combination. The best way to avoid arguments over money is to practice this principle: show grace unless you are perfect. We all make financial mistakes. Treat your spouse with grace and love versus making them wrong and yourself right. Listen to the Prudent Money Radio Show on Bible School Radio 91.3. Prudent Money, the home of the modern-day steward movement.
This is Rob Randall, your host and teacher of the Invisible War radio program. The Invisible War is the study of God's Word on how to walk in Christ's victory in the spiritual battles we face against the powers of darkness. Join me every Sunday morning at 9 right here on KDKR and KYJC in Commerce, your station for life.
Hi, I'm Jill Taylor, inviting you to join me each Saturday morning at 11 o'clock for Choose Life Radio. You'll hear people from across America sharing their stories of faith, forgiveness, redemption, and restoration. Choose Life Radio will encourage you to fully appreciate the gift of life. You may also find help for you or a friend in need, so please join me Saturday mornings at 11 o'clock right here on Bible School Radio 91.3.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. That segment went a lot longer than I wanted it to, because what I want to talk about is a conversation that I had with my wife yesterday. And I'm watching what President Trump's doing with a very close eye, because I don't know what all the motivation is behind him doing it, but it seems that every day he is doing some things that I agree with, also doing some things that I don't agree with, and are completely unprecedented. And finally somebody from the Federal Reserve Board who he fired, which he can't do that, is fighting back. So, but up until then, he's really been able to do thus far whatever he's wanted to do. And so I was telling my wife, Sherry, about this story last night. And as usual, she humors me and listens, but because I'm sure she doesn't find it as interesting as I do. Probably nobody does. But She looked at me and she goes, where does inflation come from? But first she asked me, well, really help me understand what inflation is. And I got to thinking that as members of the social media, radio, podcast, blog universe, everybody who shares information, and I find I am at fault of this as well, is that sometimes we don't slow down long enough to talk about what some of these terms mean. And I wanted to take some time and explain what's really at risk here, because there is a tremendous amount that we are getting close to seeing what this really means. And it comes down to interest rates, it comes down to inflation. And so let's start with inflation. Inflation is basically a supply and demand problem. Okay, and you may go, but you've already lost me. Just hang with me on here, and I'll make it make sense. It's a supply and demand. There is a big demand for a small supply of widgets. I always like to use that as an example. Widget, and that widget can be a toy, can be a tool, can be an electronic device, whatever you want to call it. But there is a big demand and a low supply. So the low supply is going to go to those who can pay up and pay more money and pay a higher price for it, because demand is so great. And so eventually that widget goes up in value and goes up in price to a point that meets demand. And then when anybody can buy one, the inflationary pressures go away. So there is demand pull inflation, and this will, I promise you, will make sense when we talk about it. A cost push inflation, built-in inflation, and then what I call a category that I add to it is called expectation inflation. Let's start with demand pull inflation. This occurs when the demand for goods and services, the demand, exceeds their supply. We just talked about that, leading to higher prices. It's often summarized as too much money chasing too few goods. So we got the money over here, but we can't pay the prices because demand is so great and we don't have enough supply to meet demand. So this could occur increased consumer spending due to tax cuts or wage increases, government spending that boosts overall demand, expansionary monetary policies that lower interest rates and increase money supply. Now, I know that probably didn't make a whole lot of sense, but expansionary monetary policies that lower interest rates is what President Trump is trying to do. And that is what you've got to be aware of. Unprecedented what he's trying to do. And the fight that he's having with the Federal Reserve Board, unprecedented. And if he were, well, nothing surprises me, but if he were to win that fight, he would take over a portion of power that a president has never had. So whether you like him, you don't like him, whether you agree with what he's doing, whether you don't agree, that is an opinion that's backed by a lot of research. I'll just leave it at that. Cost push inflation. This type arises when the cost of production increase, causing producers to raise prices to maintain profit margins. That could be to rising wages. So we don't really have that problem today. Increased prices for energy and raw materials. We're starting to see that. And supply chain distribution. So anything that keeps supply from getting to where it needs to go to satisfy demand is what that's talking about. Built-in inflation, also known as wage price inflation. This happens when workers demand higher wages to keep up with rising living costs. Employers facing higher wage costs increase prices for their goods and services, creating a loop of wage and price increases. Now, let me before you change the channel, let me explain that. To put it in very, very simple terms, it's whatever increases prices, and that could be a low supply, high demand, low supply. So in other words, they're not just going to give the producer of those widgets is just not going to give those widgets away. And he's going to say, you can have one, but you have to pay twice the amount of money for it. So prices go up when that happens. If you can increase supply. Well, let me back up. The tariffs, as a good example, the tariffs that are charged to countries shipping product to our consumer base to spend money on, if they get a tariff slapped on them, there's a good chance they're going to build that into the price. So before the tariffs, let's say it was $10 a widget. They got a 20% tariff slapped on them by us. And so they go, well, we're not going to pick up the cost on this tariff, or a tax is another way to put it. And we're going to take that $3 or $2, and we're going to take the widget that cost $10 now to cost $12. So you get built-in inflation with this tariff situation. And that is going to be something we'll slowly see. But lowering interest rates, expanding monetary policy is what President Trump wants to do. And he's very set on doing it. He wants to be aggressive about it. So we have never faced that with this type of situation. So it could be that blows inflation up and inflation takes off. I think the worst case scenario is that, or one of the worst case scenarios meaning we have that the government has lost control of interest rates, is that they lower interest rates way down and nothing happens. Current interest rates don't move that much. That would be a big, big, big problem. And then there's just all the unintended consequences that we don't know that could come through issues and things that are unprecedented. Now, that's a quick lesson on how you get inflation. It's a supply and demand, and I'm sure that the best, teaching with visuals is so much easier than teaching through the radio. But anyway, hope that clears up some of the confusion or adds some context to what you already know. Let me say this, though, because tends to be quite a bit of debate. And especially over what's going on. And you got to remember something, whether you agree with him, disagree with him, like him, don't like him, whatever. It comes down to what he's doing. And nobody can say with certain that what anybody in Washington is doing is going to work. Nobody can say there for certain and sit there and say, I'm right. In arguments and this kind of thing, tend to be about me being right, you being wrong, or you being right and me being wrong. And you fight for your position all the way, never letting down. I would encourage you to remember that unprecedented occurrences can and most often do create unintended situations. And so we don't know what's going to happen. So don't jeopardize your relationships with whoever you're debating with and wanting you to be right and them to be wrong. It's just not worth it. So wanted to throw that out because I see a lot of that, and you probably do too as well. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. If you got a question for me, go to the website at www.prudentmoney.com. Send it in, and I will get you taken care of. Until we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.